things get tough, what do people start doing? I mean, we're resilient. We look for other options, other products. You can go all the way back to 15 years ago and talk about the crazy products they came up with, and there were plenty of them. Uh,
Hmm.
they were combining too many non-accountable components. No down, bad credit score, no job. Probably not a good
Hmm.
person to give a loan to.
Right.
But here, a 3-2-1 buy down, just as a quick paraphrase, is it's still a fixed rate option. It is allowing you a little bit of a gap to accept a
Hmm.
lower payment to get in and find comfort. But it converts to fixed, and you know what that fixed number is. So
Yeah.
it's a stable option, certainly in the world of alternative financing options.
Yep.
So
Well,
go
let me go
for it.
ahead and get into it. For those that want to follow along, I did put the link for reference, so you can check this out yourself. But yeah, this comes from investopedia.com. Here we go. All right, 321 buy down mortgage, meaning pros and cons and FAQs. A 321 buy down mortgage is a type of home loan that can help would-be home buyers achieve their goal of home ownership when high mortgage rates threaten to price them out of the market. The loan interest rate is reduced for the first 3 years of the loan term. In the fourth year, the original rate is applied and remains for the life of the mortgage. Read on to learn how 321 buy down mortgage works and whether one may be right for your needs. So, key takeaways: with a 321 buy down mortgage, the borrower pays a lower than normal interest rate over the first 3 years of the loan. The loan interest rate is reduced by 3% in the first year, 2% in the second year, 1% in the third year. For example, a 5% mortgage would be just 2% in year one. Okay. After the buy down period ends, the lender charges the full interest rate for the remainder of the mortgage term. Buy downs are often used by sellers, including home builders, to help buyers afford a property. How 321 buy down mortgages work. A buy down is a mortgage financing technique that allows a home buyer to obtain a lower interest rate for at least the first few years of the loan or possibly its entire life. It is similar to the practice of buying discount points on a mortgage in return for a lower interest rate, except that it is temporary. Typically, the seller or home builder, sometimes even the mortgage lender, covers the cost of the 321 buy down. The cost equates to the savings to the buyer in the first 3 years. In general, 321 buy down loans are available only for primary and secondary homes, not for investment properties. The 321 buy down is also not available as part of an adjustable rate mortgage with an initial period of fewer than 5 years. The interest rate for a 321 buy down mortgage is reduced by 3% for the first year, 2% for the second year, and 1% for the third year. The original interest rate then kicks in for the remaining term of the loan. By contrast, a 2-1 buy down, the rate is reduced by 2% for the first year, 1% for the second year, and then rises to the original rate when the buy down period ends. All right, so pros and cons of a 321 buy down mortgage. Darren, hold on. I got to get this chihuahua.
I can't hear anything, by the way.
Yeah, oh, that's good. Here, I don't know what he's.
Ah, the
I can
joys
tell. I can tell
of
you he's
of
bugging
home
me.
office, man.
This is
Nice.
this is the culprit right here. Yeah.
I can't lift mine up that easily, man. You know,
Yeah.
110 pounds. That's a little harder to move around.
All right. Well, let's get back into it. Pros and cons of a 321 buy down mortgage. So the pros are a 321 buy down mortgage can be an attractive option for home buyers when mortgage rates are high enough to discourage a home purchase. They give home sellers a way to entice buyers in challenging housing markets. Buy down loans can be advantageous for borrowers who may not have the needed funds today, but expect to have higher incomes in future years. Over the first 3 years of lower monthly payments, borrowers can set aside cash for other expenses, such as home repairs or remodeling. When the loan finally resets to its permanent interest rate, borrowers have the certainty of knowing what their payments will be for years to come, which can be useful for budgeting. A fixed rate 321 buy down mortgage is less risky than an ARM or a variable rate mortgage, where rising interest rates could mean higher monthly payments in the future. Okay, the cons. A potential downside of a 3-2-1 buy down mortgage is that it may lull the borrower into buying a more expensive home than they can afford. The lower monthly costs are temporary, and home buyers must be prepared for a jump in payments. Borrowers who assume that their income will rise enough to afford future payments could find themselves in financial troubles if this fails to occur. Let's see who subsidizes 3-2-1 buy down mortgages. The savings experienced by the home buyer in the first 3 years of a buy down mortgage term represent the cost of a 3-2-1 buy down mortgage. Typically, the cost is covered by someone other than the buyer, the seller, home builder, or even the lender. For example, motivated sellers might be willing to pay the cost in order to attract buyers and close the deal. In some circumstances, a company that's moving an employee to a new city might cover the buy down cost to ease the expense of relocation. More commonly, real estate developers will offer buy downs as incentives to potential buyers of newly built homes. Is a 3-2-1 buy down mortgage right for you? As mentioned, it can be risky to get a 3-2-1 buy down mortgage on the assumption that your income will rise sufficiently over the next 3 years so that you'll be able to afford the mortgage payments when they reach their maximum level. For that reason, you must consider how secure your job is and whether unforeseen circumstances could make your house payments unmanageable once you reach the 4th year. In addition, if by some chance you have to pay for the buy down on your own, then the key question to ask yourself is whether paying the cash up front is worth several years of lower payments that you'll receive in return. For example, you may have other uses for the money, such as investing it or using it to pay off other debts with higher interest rates, like credit cards or car loans. If you have the cash to spare and don't need it for anything else, then a 3-2-1 buy down mortgage could make sense. The question is easier to answer when another party foots the bill for the buy down, but even then, ask yourself whether the maximum monthly payments will be affordable. Could the enticingly low initial rates lead you to want a more expensive home and take on a larger mortgage that makes sense financially? You'll also want to make sure that the home is fairly priced in the first place and that the seller isn't padding the price to cover the buy down cost. What does a 3-2-1 buy down mortgage cost? The cost of a 3-2-1 buy down mortgage is the total amount that the buyer saves over the 3-year period of lower rates. Who pays for a 3-2-1 buy down mortgage? Usually the seller, home builder, or lender pays the cost of buy down mortgage. Employers will sometimes pay for a buy down if they are relocating an employee to another area and want to ease the financial burden. Sometimes the borrower may pay for it. Well, it's kind of repeating itself, but
Yeah.
What do you think, man? What do you think of this product?
Well, you know, I like it that it's approaching it from a conservative perspective, and it keeps talking about um, an increase in future income, and that's clearly probably the most likely scenario.
Right.
It could be, somebody is going to go back to work in a year. Maybe one family member is going to do that. So that's clearly an increase in income based on that.
Yep.
It could also be, yes, trying to increase cash flow in the first few years if you plan on doing improvements, knowing that you can afford the future number. It could be that you can just convince a seller to do it for you, but the relative point they bring up is make sure you're not overpaying for the house in the process of doing that. So I think there are a good amount of scenarios where this is just a win-win for the buyer. The one scenario where it's and the fact that it becomes fixed after the 3 years and isn't going to adjust makes it a no risk product, as long as you truly are comfortable paying that the full amount, the 4th year amount going into it, and are good at planning for that.
So the question that I had is, can you refi this later?
Of
Or
course
they want
you
a
can.
certain, right? So,
Yeah.
but at that 4th or 5th year, are they requiring at least a minimum?
No, there's no prepayments
So you
in
could,
this.
okay,
They're actually collecting all that money up front from who's ever paying for it. It doesn't make sense to pay for it yourself because you're now paying that money in advance that you would end up paying anyways. So yeah, you can own the house for 2 years and sell it. and get the tax benefits of owning it for 2 years, or sell at any point. There are not prepayment penalties attached to these.
Okay.
So
All right. Well,
there really
that's the out
aren't.
I wanted to hear. Great.
Yeah, there are not additional constraints. I mean, the other potential, right, which they didn't talk about in this article at all, is, uh, you know, I'm always concerned about people planning for the future. When I hear a buyer say, "Well, I'm willing to make that payment now, but I'll just plan on refinancing in 2 years and rates are lower," you
Mm-hmm.
know, you can't count on that in that scenario.
Right.
You've got to be willing to buy with today's rates. And of course, if rates are lower in the future, you're going to refinance you and everyone else. And that's
Right.
fantastic. It could be a bridge, a better bridge to that
Mm-hmm.
refinance option if it comes. You're going to be getting that lower. You can say, I'm comfortable in this range. And after a couple of years, maybe I don't want to pay that big payment. Do I have an out? Does it make sense to sell as
Mm-hmm.
my rate resets?
Yeah.
Who knows where house value that relates then to future house values. So case by case scenario, but it's a
Yeah.
nice product that could really help some people get into a house
Mm-hmm.
who can have some semi predictable future changes in their financial situation.
Okay. All right. Well, there you go. We'll look for some other opportunities like this for buyers in the future as well, I think. I know you mentioned a couple already, so we'll
Yep.
we'll keep following up.